Hello, Investing Putts back with you again. Most of the videos I've made have been on the poor man's covered call. It's what I've been trading for the last year for the most part. Not that I don't trade anything else, but it's where most of my money's been tied up. And I've had highly variable success. Some really good stocks and some really bad ones. It's not a dumb, blind strategy that you can just throw at any stock and expect to add 5% of return on top. No. Even though all the YouTube clickbait crap tells you that, it is not true. Okay, so in my previous video, I reviewed many of these stocks, how they performed, they performed for me, actually. And I'll just focus on two exemplars. So in general, the poor man's covered call very nicely hedges against a gradual decline in a stock. On the other hand, if the stock rises gradually, you're able to capture most of the upside. So in theory, this sounds like the perfect strategy. You get all the upside and none of the downside. So on the other hand, the poor man covered call performs terribly when the stock moves rapidly up or down. So here's a graph of perhaps my most successful stock with the poor man's covered call, XLI, which is the Spider Industrials Index ETF. So over the last year, there were no rapid 5% drawdowns or rises in the stock price. So by rapid, I mean 5% moves that happen over 1, 2, 3 days in general. So even better, the implied volatility of a short-dated at-the-money call is 23% for XLI, which is far better than the SPY at 16.5%, even though the historical volatility of XLI is similar or maybe lower than SPY. So this high IV means that the calls that you sell will fetch a very nice premium. So here's a price graph of GLD, which in my experience is a very bad stock for the poor man's covered call. Over the last year, I count 5 drawdowns of 5% or more that happened over just a few days. By the same token, I count 5 rapid rises of the stock greater than 5% that happened over a few days. So the very worst thing that can happen is the whipsaw, and I see 3 whipsaws. It's where the stock falls rapidly, only to rise rapidly a few days later. So when it falls, you will buy back your short call, and then to salvage your position, you sell another short call at a lower strike. So then the stock price rises quickly, and that short call is suddenly deep in the money. And your net delta is probably 0 or even negative on the position. So essentially you've given up all your upside very quickly. And so it gets disastrous when you have these whipsaws. So the worst part of GLD is the implied volatility, which is only 18% for a short-dated at-the-money call. This is similar to SPY, even though GLD has had many plus or minus 5% moves in the last year, while SPY has basically had none, rapid moves. And XLI had a 23% implied volatility. So with GLD, you're just not getting paid for the risk that you're realizing. So in summary, the poor man's covered call is not a dumb, blind strategy that allows you to juice the return on any stock. You need to choose your stocks carefully. It comes down to historical and realized volatility versus implied volatility, which governs the prices of options. It also boils down to how you define volatility. I think the simplistic definition does not work for the purpose of the poor man's covered call. So for the poor man's covered call, I would define volatility as the frequency of huge rapid moves up or down. GLD has a low IV because it's pretty quiet in between those huge rapid moves. But the rapid moves ruin the returns of your poor man's covered call. So what you want to do is find stocks that A, tend to go up, because the poor man's covered call is a net positive delta position. B, don't have frequent rapid moves up or down. And C, have a relatively high IV for the number of those rapid moves up or down. So anyway, this was useful. This was useful for me actually to kind of wrap my brain around it, try to summarize why I think my results. It's not that my results have all been bad. Some have been good and some have been bad. So on average, mediocre. But the problem is, because there have been some good results, I don't want to throw out the strategy in general. I want to just cherry pick the stocks that I think are going to be better. So I think I've hopefully communicated that to you. Is it going to be correct? Yeah, we'll see. I'll trade it, and I'll let you know what I find. And if you trade it too, let me know in the comments. Let me know what you think. See you later.